Are you guys tired of trying to cash for keys your buildings and thought about getting into construction? Well, in this video, we're going to sit down and take a look at why we think the economy is prime for mid-level investors to get in construction.
Multifamily was where most investors were pushing because they were getting pushed out of the residential space. And what we're seeing right now is things are starting to make sense now in the construction space. Purchasing these multifamily buildings isn't necessarily the easiest to do anymore because there's a lot of people who are looking to get into them. The price points are pretty high now on cost per unit basis, and the banks are tightening up a little bit in regards to the required liquidity needed to actually do it.
The commercial multifamily space has definitely cracked down on their underwriting and internal valuations and whatnot. So when we see our investors who have the capital and the experience and a new way for them to optimize that cash flow and get that equity takeout and returns, they're moving into development. You can bang these projects out in under a year, 12 months, which is much quicker than you're going to get a repositioning product these days with an equity takeout. So I think that's definitely pushing a lot of investors in the construction side.
Hey guys, Josh Ehren back for another Finance Friday, and it is the end of 2023, beginning of 2024. 2023 was a crazy year for a lot of investors. For the mortgage business, we saw a lot of ups, a lot of downs. The residential market got hit pretty hard with volume decreases. We had a lot of clients move into the multifamily space. Just a very dynamic year, a lot of ups and downs of rates. And I guess the million-dollar question most people are asking us right now is, what does 2024 hold for investors and developers? And in today's video, we want to discuss construction financing and how we're seeing it play out in the Ontario and Canadian real estate market, and why we think it's actually going to be important for you guys to understand in the future.
Yeah, I think cash is king is a very great way to describe 2023 and probably describing, the real estate market moving forwards. For those who have the money, there's tons of opportunity. And I think that's going to be the story of the game moving forwards as we get into 2024. Lots of things going to be hitting the market, some power sales, lots of opportunity. And again, those who have that cash and have the liquidity are going to be able to take advantage of those deals. They're going to be able to move quickly. They're going to get things done. And, we're going to talk about how, projects in 2024 are going to look and outlook in, 5 to 10 years as these interest rates start to normalize. And why we think construction is becoming so popular, especially at a lower to mid-level, mid-level investors, and why they're getting into it.
I think it's important just to understand where we're at right now. We're finally at the point where bond rates are dropping. We've had Jerome Powell a few days ago. He came out and said that they're expecting rate cuts now. At least 3 of them next year. And if you're looking at what we're going to do in Canada, most people look at the United States. So it's a little bit more optimism in the market at the moment. Bond rates are dropping, fixed rates are dropping. People are anticipating on making moves next year because there's a little bit more certainty in the market as to if rates are going to go up or down. CPI is under control. For the most part, we're on a trend towards where the Bank of Canada wants us to be. And I think people who are sitting on the sidelines with capital are finally looking at this as a glimmer of hope to be able to move forward. What does that mean for investors? Realistically, you and I deal with people every single day, and the residential real estate market as a whole hasn't moved a ton this year. We've seen prices stay pretty high in regards to the average affordability ratio. Most people still can't afford to go and buy the homes at the price points they're at. And for investors who are looking to purchase, duplexes and triplexes, it's still decently difficult at $200,000 or $300,000 a unit to be able to acquire these. Most people have seen the progression of Ehren and I's business and how multifamily was where most investors were pushing because they were getting pushed out of the residential space. And what we're seeing right now is things are starting to make sense now in the construction space. Purchasing these multifamily buildings isn't necessarily the easiest to do anymore, because there's a lot of people who are looking to get into them. The price points are pretty high now on cost per unit basis, and the banks are tightening up a little bit in regards to the required liquidity needed to actually do it. So what are you seeing in that push towards construction, and why are people looking into it?
Yeah, I think you take a look at CMHC came out in September and put in the policy, for a 24-month stability period. So it is becoming a lot more challenging for investors to get in and stabilize these buildings and get that equity takeout. You can stabilize a building, but these refinances with CMHC, if you're not looking to take that 24-month period, you're getting these refinances done at the purchase price. So there's not that same ability to burn and take out that equity and repeat as there was prior to this policy coming out. As much as we try to work on these workarounds and whatnot, it's still very difficult, and the commercial multifamily space has definitely cracked down on their underwriting and internal valuations and whatnot. So when we see our investors who have the capital and the experience and a new way for them to optimize that cash flow and get that equity takeout and returns, they're moving into development. With a lot of the municipality changes coming, allowing for 4 units on residential zoning, and some of the tax rebates that we're getting on purpose-built multifamily buildings. Again, those investors that have the cash and the capacity to get it done are seeing this as a much quicker way to be able to get into projects, expedite the projects, get it done, and have a much higher IOI compared to sitting in a repositioning product for 2 to 3 years and just trying to carry that out on high interest debt in the hopes that they get that refinance and take that equity out. On these smaller 4 units now, or I guess anything under 10 units now, where you don't even need site plan approval, you can get in and out. You're not waiting on the city. You can bang these projects out in under a year, 12 months, which is much quicker than you're going to get a repositioning product these days with an equity takeout. So I think that's definitely pushing a lot of investors in the construction side.
Yeah, cost of capital, like just in general, that cost of doing a small to mid-sized multifamily in a type A area right now, you're over $1 million of cash to be able to execute on a project effectively. Like, there's an inflection point here where investors are saying, hey, why am I spending all this money and I'm not moving it? There's no velocity of it. So, that transition to maybe there's some products out there that I don't have to be limited by being able to take my money out. I don't have to sit in a product for 2 years. I don't have to spend the costs and fees on being able to burn interest on waiting to move that money. I don't have to deal with tenants. There's a massive, as we've seen in 2023, the difference between legacy tenants and where market rent is right now, it's not as easy to be able to get that natural turnover or turnover in general on a property anymore. And it's pushing investors into that development and construction space.
Yeah, and I think, if you understand the relationship between interest rates and market capitalization rates and taking a look long term ahead, if you're building commercial real estate right now and you're planning on holding on to these buildings afterwards, if you're building at the highest interest rates that we've seen in a while, these interest rates are coming down. Like we mentioned, we just saw close to 1% or a full percent drop on the 5-year bonds. The next 5 to 10 years, as these rates come down, your cap rates come down. So if you can hold on to these buildings now at these high interest rates and make it work, when these cap rates shrink and come back down, in conjunction with 12% year-over-year rent increase, the value increase on these buildings in the long term is going to be substantial.
Yeah, astronomical. I mean, the ability to be able to put market rents in on a building now and be able to make the numbers work at today's rates, as you said, it's the long-term play here is going to have investors really profit overall. And I think that mindset shift between quick money the last 3 to 5 years versus that long-term play now, these people are starting to look at, okay, well, what is that play? Because those quick, massive appreciation gains, that's not realistic anymore in the market that we're moving into or towards. So that mindset shift with investors now is definitely been something substantial. And what we're seeing is, these projects are just having multiple people in them now. It's not just a single investor doing duplex or triplex by themselves. It's 2 or 3 people who are working together, pulling their resources and net worth and capital and experience to be able to do these projects. These projects are taking a little bit more expertise, and it's taking a little bit more time to be able to navigate how to do this, but we're seeing that natural progression, and we have seen a handful of people come together to be able to create groups to start doing this in major markets.
Yeah, and this doesn't mean that you have to jump right into building, a 72 unit, 7-story tower. It's we're seeing a lot of guys, keeping on, the expediency of capital, who like this like sub 10 unit. Again, without the SPA, you don't have to wait around municipal. It means you're not holding on to land or buildings with private debt as long. These projects are getting completed in 12 months. And if you want to take a look at, creativity with structuring, you can start building, fourplexes side by side and, sell it or refinance a whole package into CMHC as 8 units. So, compared to building these, 10 or, units over 10 where you have to deal with SPA in the city and you're sitting into these loans longer and you're holding on to this private debt a lot more. Some of the guys that I've seen, they're getting these SPA projects for the larger 60, 70 units, and they're selling those projects off at SPA, and they're taking that money and they're putting it into these short little construction projects, taking advantage of municipal zoning, and they like how quick they're going to be able to get in and out on those, either sell them individually as 4, sell them as 8, refinance them as 8, whatever that is. That's much more enticing to them in terms of how quickly they're in and out versus those large development projects. But again, that's all going to depend on you as an investor and what your capital looks like and your experience and what do you want out of your projects. But we're seeing viability at both ends.
For sure, and I think if you take a look at, just listen to what the government is saying. They are pushing the fact that we have no supply, that we have massive demand, and it's going to continue to come as we have immigration come into the country. Now, immigration is needed, but we need to house people, and that demand isn't going to stop. So the government is pushing, increased bonds. So they just added $15 billion to 10-year CMB. They are pushing the new wartime measures, but it's wartime measures
for housing, yeah.
Wartime measure housing to be able to expedite site plan approval on projects. They have a mandate to push this development and to create multifamily. I think you're going to see a lot of people and a lot of banks push towards being able to help people do this. Historically, there hasn't been a ton of options in the market. And over the last little while, we've seen a bunch more either private and conventional people get into the market and offer some pretty aggressive products.
Yeah, I think even just from like a basic macro level of economics, we have a huge housing shortage and we have a huge, ever increasing demand. Last year we were 1 million plus in immigrants, depending on which number. I'm sure we're going to be at least 500,000 again, 2023, 2024. And, the numbers, that we're seeing come from the government on built homes, we're already behind, what the initial government promise was. So, you take that, you add that in conjunction with the rents, again, 12%, 11% year over year. It's just a perfect storm. And, the big developers, they're not going to be building, with margins this small. They didn't become billion-dollar families by building on razor-thin margins. So while costs are high and interest rates are high, and even though they are coming down, we're not going to see them be as aggressive. So this is where, our mid-level, large-level investors that have the capital, there's a huge opportunity for you guys to come in and do that part and still be able to make profit for yourself and be able to give back to the community.
And it's interesting because, Aaron and I were at the Toronto Real Estate Forum the other day, and they were talking about how these big guys aren't penciling deals. They haven't penciled deals for the last 3 quarters, and they don't plan on it until numbers start fundamentally making sense for condo buildings, for selling these projects for profit. But being able to keep these assets, being able to keep $100, $200, $300, if you have $300,000, if you have a few people in it, keeping a little bit of equity in these projects, but these cash flow machines, it's starting to become a viable option for a small to mid-sized investor who's looking to actually own quality turnkey multifamily assets.
So for those of you that are already in construction development, we are going to be putting out a little bit of a little mini series on construction and development. We're going to talk about, on this episode, the macroeconomic overlook. Going to touch on some of the products that are out there for construction, taking a look at, the difference between build to sell and versus build to rent, and just try to get you guys as informed as possible for all your decisions moving forwards. Again, we appreciate you guys watching. If you have any questions, drop the comments down below. Josh and I's contact information will be there as always, and reach out if you have any questions.